Hello, Professor Kiss here. I'd like to make a brief video for you on financial planning, forecasting, and growth so that you can watch it and when we can spend time in our class working through some practice problems. So the first thing we want to do when we're doing financial planning, and remember I did this both as a CFO and as the corporate treasurer of a manufacturing firm, is come up with a forecast. Many cash flows depend directly on the level of sales and often are estimated using a growth rate in sales. The next thing we'll do after we have our level of sales is come up with what we call pro forma statements. These are setting up the plan as projected financial statements for consistency and ease of interpretation. You've done stuff like this before when you have done DCFs and you have forecasted free cash flow. Well, now we're actually going to forecast items on the income statement and balance sheet. Now, anytime we're going to expand our sales, we will need to have more assets. We might also need to have more fixed assets, more machinery, more warehouses, more buildings. We'll see how much we're going to expand. And then the part that I always care most about, how much financing we're going to need to pay for those required assets. We will then discuss both dividend policy and capital structure policy. If new funds are to be made, what type of securities, bonds, stocks, using retained earnings, which of course is another form of equity. And then because our balance sheet won't balance, we'll have to have some plug value to make a decision to make the balance sheet balance. Also involved in our financial forecast is some economic assumptions. If we are making products to sell in a grocery store in this period of COVID, great, doing well. If we're looking at Zoom, going to do well in this period. Whereas if we're looking at a hotel or a restaurant, may not be doing so well in this economic environment. And also will make an interest rate forecast. So let's look at a simple company, very simple, Gourmet Coffee. As of December 31st, 2018, it had 1,000 in assets, 400 in liabilities, 600 in equity. The balance sheet balanced, and the simple income statement. And notice that the balance sheet is at a date in time. The income statement is for a period of time, and this example, a year ending December 31st. 2,000 in revenue, 1,600 in costs, giving us net income of 400. Now let's make some simple assumptions. Let's let revenues grow next year at 15%. And let's assume that all items are tied to sales and our current relationships are optimal, then everything else will grow at 15%. The only thing that won't grow exactly that way is retained earnings. Our new number for retained earnings will be our old number for retained earnings plus any net income for this year minus the dividends going to be paid out this year. So the change in retained earnings is net income for the year minus dividends paid out. So here is our example for the year ending December 31st, 2019. Net income will be 460, and then we'll use that to decide how we're going to have our dividends paid. So here is our example. Now notice that our equity before was 600. Now we have said we've got net income of 460. I said our equity is only going to grow 15%, that's 90. Well, I've got 460. That means we're going to have to figure out what our dividends will be. So, one thing we could say is if we want only an increase of 90 coming from retaining earnings, our dividends will be our plug variable. We will pay out $3.70 in dividends, a very high dividend payout ratio, because we only want equity to grow by 90, and it will all grow by using retained earnings. In our second example, we are going to let our equity increase by the full $460 of retained earnings. Therefore, we will not need too much debt. Debt will be our plug variable, and it will go down from $400 to $90. We will be repaying a lot of debt. So we need to make that decision how we might change our capital structure. Now, some items tend to vary directly with sales, while others do not. On the income statement, typically costs will assume vary directly with sales. That will keep us a constant profit margin. Depreciation, we know, is based on book value of our assets, so that may not vary directly with sales, and interest expense also won't. If that is true, then our profit margin will not be constant. Dividends are a management decision and generally do not vary directly with sales. This will affect the retained earnings that goes on the balance sheet, just as we saw for our gourmet coffee company. Our balance sheet, we initially will assume that all assets and even our property, plant, and equipment will vary directly with sales. Accounts payable also usually varies with sales, but notes payable, long-term debt, and equity generally do not, because they depend on management decision about the capital structure. The change in the retained earnings portion of equity will come from the dividend decision. But what I'm most interested in is the net new financing needed, the difference between the forecasted increase in assets and the forecasted increase in liabilities and equity. And typically on an exam, I will give you a problem where you need to calculate the net new financing needed, along with the forecasted sales and the change in retained earnings. So let's look at the steps in the estimation of our pro forma balance sheet. We'll first look at the items that vary with sales as a percentage of sales, and I'm putting those in green. Then multiply the percentage determined in step 1 by the projected sales to obtain the amount for the future period. If we don't have anything that's depending on sales, we'll simply insert the previous balance sheet figure into the future period. Then, as I said before, we compute our retained earnings as our present retained earnings plus our projected net income minus our planned cash dividends. We'll add the asset accounts to determine projected assets, add the liabilities plus equity accounts to determine the total financing, and any difference is the shortfall, that is the net new financing needed. Use that plug to fill in the net new financing to finance our growth. So the difference between assets and liabilities plus equity indicates the net new financing to fund our growth. So let's look at another example, a little bit more complicated than gourmet coffee. This is Tasha's Toy Emporium. There is the income statement as of 2018. It had sales of $5,000, maybe this is $5 million. Costs were 60% of sales of $3,000. Earnings before taxes, therefore, is 40% of sales or $2,000. Taxes at 40% gives us net income of $1,200, 24% of sales. Now, right now, let us assume that both the dividends and the retained earnings are equal to 50% of net income. Our dividend payout ratio is 50%. Our plowback or retention ratio also is 50%. Then we're going to project a 10% growth rate, bringing sales to $5,500, $3,300 cost, $2,200 earnings before taxes, taxes of $880, Net income 1320. Everything's been growing with sales, and we're going to keep the same dividend payout ratio of 50%. So our addition to retained earnings will be half of our net income, and the other half will be paid out as dividends. Now let's look at our balance sheet. I assume that everything on the balance sheet would also grow 10% on the asset size, even our property, plant, and equipment. On the liability and equity side, the only thing that grew with sales is accounts payable. That is going to grow to $990. I'm keeping notes payable constant at $2,500. I'm keeping long-term debt constant at $2,000. I'm keeping common stock plus additional paid-in capital, that's what APIC is standing for, constant at $2,000. I've said we're going to add $660 to retained earnings, giving us here a total of $10,250. Notice total assets is $10,450. Total liabilities plus equity, $10,250. $450 minus $250 is $200. That is our additional financing needed. We must come up with an additional $200 in debt or equity to make the balance sheet balance. So we can choose what we want to be our plug variable. We can borrow more short-term notes payable, borrow more long-term debt, sell some common stock, or we could decrease our dividend payout, which will increase our addition to retained earnings. But of course, additions to retained earnings is not external financing. Now, I've assumed that the property, plant, and equipment also grew the same percentage, 10%, as assets. That is probably not true. Typically, a company may not be operating at full capacity. For example, suppose the company's operating at 80% capacity. Then they could grow sales up to $6,250, $5,000 divided by the percentage capacity, and they could still not have to increase property, plant, and equipment. In my example here, with a 10% increase in sales, we would only be operating at 88% capacity. Therefore, no additional fixed assets would be required. Then we would see that our total assets would only be $10,050. Our liabilities plus equity, we said, is $10,250. Now what we have is excess funding. So now we could repay some short-term debt, our notes payable, repay some long-term debt, buy back some stock, or pay more in dividends, reducing our addition to retained earnings, or if we want to increase our assets, just have the cash. Now, operating at 80% capacity is not a magic number. I'm just giving you an example. But I will tell you, when I was treasurer of a manufacturing firm, we had a lot of sales that was just temporary. So my boss did not want to hire some more people, but instead brought in some temporary workers and add a second shift. Because our equipment was being idle after 5 p.m. We had people come on for additional 6 hours at 5 p.m. We paid them, and so we were able to operate our equipment. Now, when you operate your equipment 24/7, as some companies do, it may wear out faster, may need more repairs, or may need to be replaced. But more typically, there is some slack, excess capacity in the property, plant, and equipment. So we will work problems in class on Monday to work with both some excess capacity and when we have full capacity. So we do and don't increase our property, plant, and equipment. Now, at low growth levels, internal financing may exceed the required investment of assets with no external financing needed. But as growth increases, it may not be enough, and we may have to go to the capital markets for money. Experiencing the relationship between growth and external financing is a useful tool in long-range planning. So we look at internal growth versus sustainable growth. And we will see that the return on equity will be larger than return on assets anytime you have debt. You saw that in 340 with the DuPont relationship. Internal growth rate assumes no external financing. Sustainable growth rate says you'll use some outside financing equal to the amount of your debt to keep your debt to equity ratio constant. So we can look at different formulas here with Tasha Toy, but I want to look at sustainable growth here, and there's a different relationship, and I want to show you that here with Tasha's Toys because I want to show you from your textbook's example. This is chapter 18 in the Berk textbook. The internal growth rate is net income over beginning assets times the retention ratio, which is 1 minus the dividend payout ratio, or the return on assets times the retention rate, and the sustainable growth rate is net income over beginning equity times the retention ratio, or 1 minus the dividend payout ratio. This is the rates that you should learn, the ones that are in your textbook. Thank you. So summary here, to find internal growth, return on assets times retention rate, finance only by retained earnings. To grow faster, you must reduce your payout or raise external capital. For sustainable growth, return on equity times the retention rate. Keep your debt that keeps your debt equity ratio constant. To grow faster, you must either reduce your payout, raise new equity, or increase your debt. Now, what's involved in our determinants of growth? Our profit margin, or our operating efficiency, our total asset turnover, or asset use efficiency, and our financial leverage. Again, do you remember this from the DuPont equation? All of these are involved in the DuPont equation, but we have one additional thing here in our advanced corporate finance, the dividend policy. Choice of how much to pay to shareholders versus reinvesting in the firm. It's important to note, though, that growth is not the goal of the firm in and of itself. Growth is important only so long as it continues to maximize shareholder value. We could grow sales by cutting prices, but this would squeeze margins and probably reduce overall earnings. Internal and sustainable growth rates are useful, but they can't tell you whether your planned growth increases or decreases the firm's values. But growth greater than sustainable is not bad as long as it increases the value of the firm, but we will need to raise additional capital to finance the growth. So this is just giving you an idea of how Starbucks has done, and it has grown at times above and below its sustainable growth rate. So we remember also we're working with accounting numbers. We must ask some important questions. How does our plan affect the timing and risk of our cash flows? Does the plan point out inconsistencies in our goals? If we follow this plan, very important, will we maximize our shareholders' or owners' wealth? So how does excess capacity affect the forecasted ratio and the need for note financing? Sales won't change, but assets would be lower, so turnovers would improve. Less new debt, lower interest expense, higher profit, earnings per share, return on equity, debt ratio, and times interest earned would improve. How would each of the following affect the new funds needed? Higher dividend payout ratio, increased net financing, less retained earnings, higher profit margin, decrease the new financing needed because higher profit allows us to retain more earnings. Higher capital intensity, higher assets per sales. We need an increase in our financing, need more assets for the given sales. Pay our suppliers in 60 days rather than 30 days. That will increase our accounts payable. Using trade credit, that will decrease the financing we need. So here you can read on this slide the answers in more detail. And then we will work through some problems in class. Thank you very much for your attention.